to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, don't miss an exclusive interview with Peter Kraut, author of the book The Silver Bull and publisher of The Silver Stock Investor. Peter weighs in on the recent price action in silver and explains that the physical silver market remains very tight, with shortages and high premiums reported in major markets like London and Shanghai, suggesting an underlying supply deficit. Mike Meharry and Peter also discuss how silver mining stocks continue to lag the percentage gains seen in the silver bullion price, and whether or not we can expect to see the mining sector finally reflect the full leverage of the rise in silver prices that a mining stock investor would expect to see. So be sure to stick around for another wonderful interview with Peter Kraut coming up after this week's market update. And as a reminder, please download, like, rate, and subscribe to this podcast, wherever you consume this content. A fundamental dynamic is driving the rally in silver prices. There simply isn't enough metal. After a massive new breakout last week, silver rallied to over $58 and traded in that range throughout this week. We're looking at a literal double in the silver price here in 2025 with only a few short weeks left in the year. Our listeners will remember that there was a mini silver squeeze last month that helped propel the price up to $54 for the first time ever. At the time, analysts explained the situation as a temporary displacement of metal. Last spring, significant amounts of silver flowed into the U.S. due to tariff worries. This led to a shortage of metal in London. According to Bloomberg, the amount of free float silver, metal not committed to ETFs or other funds, dropped from a high of 850 million ounces to just over 200 million ounces, a 75% decline. Metals Focus estimates that the available metal dropped as low as 150 million ounces. Unprecedented silver demand in India pushed the silver market over the edge. With gold at record highs, Indians turned to silver. This put further pressure on London supplies. The market ultimately adjusted, with metal flowing back from New York to London, easing the squeeze. However, after a pause, silver has again resumed its climb. As an ANZ Group analyst put it, quote, "Shortages in the global market as a result of the recent squeeze in London are still being felt," end quote. It's not so much that there isn't enough silver in London. The problem is that there isn't simply enough silver anywhere. The recent flow of silver into London has shifted the squeeze to other centers. Warehouses associated with the Shanghai Futures Exchange report the lowest silver inventories in nearly a decade. They're so low that China will be banning silver exports starting next month. Meanwhile, silver lease rates have climbed, reflecting strong demand and a limited supply of available metal. This isn't a problem that can be solved by moving metal from one warehouse to another. The issue is that demand has outstripped supply for several years, and it's slowly but surely pressuring the available stockpiles. According to Metals Focus, silver is on track for its fifth straight structural market deficit. After setting a record in 2024, industrial demand is expected to drop by about 2% due to the price pressure. That will drive overall demand down by around 4%. However, with mine output flat, there still won't be enough metal produced to cover the offtake. Metals Focus projects demand will outstrip supply by 95 million ounces this year. That would bring the cumulative 5-year market deficit to 820 million ounces, an entire year of average mine output. To make up the supply deficit, silver users will have to draw from existing above-ground stocks. That will likely require higher prices. Even with higher prices, it is unlikely that mine supply will quickly grow to erase the supply shortfall. Silver mine output peaked in 2016 at 900 million ounces. Up until last year, silver production had dropped by an average of 1.4% each year. In 2023, mines produced 814 million ounces of silver. It appears that, for the next few years at least, we will have to depend on drawdowns of above-ground stocks to meet the silver supply deficit. Silver is also getting a boost from expectations that the Federal Reserve will continue easing monetary policy. The U.S. recently added silver to its list of strategic minerals. This could add to demand pressure and supply shortfalls. Meanwhile, fear of a sudden premium on silver in America has made some traders hesitant about sending the metal out of the country, offering little prospect of relief should the global silver market tighten further. There are also worries that the U.S. could impose tariffs on silver to protect the domestic supply. These fundamental supply and demand dynamics should continue to support the silver price, at least in the near to midterm. As for the up-to-the-moment market action here, silver is currently trading at $58.74, up nearly $2 on the week, or 3.2%. Gold is essentially unchanged at $4,228. Platinum is down 1.7% to trade at $1,657. And finally, palladium is off 0.5% to come in at $1,482 an ounce as of this Friday midday recording. Moving to other news, somebody dropped nearly $11,000 of gold into 2 Salvation Army kettles in the Chicago area. According to the Salvation Army, 8 gold coins showed up in 2 separate donations at the Red Kettle campaign outside a pizza place. The haul included a 1-ounce American Gold Eagle valued at over $4,200, along with 7 other smaller coins. As a bonus, the Salvation Army can hold on to the gold for a while if it wants to, without worrying about the relentless devaluation of dollars courtesy of the U.S. government and the Federal Reserve. Virtually every year, we hear stories about generous donors pitching gold into Salvation Army kettles. Gold donations have been reported in Arizona, Pennsylvania, Michigan, California, and other states in recent years. These gold donations almost always make the news. That's because everybody recognizes the value of gold. A quarter is a quarter, unless, of course, you have a pre-1965 quarter that is 90% silver, and a dollar is paper. But gold? Now we're talking about real money. If you're still looking for a last-minute Christmas gift, perhaps you should consider the gift of gold or silver. We can guarantee your gift won't end up in a garbage can next year, and it will likely be worth more than when they opened it. Be sure to check out Money Metal's holiday gift shop for valuable and memorable gift ideas. Just visit moneymetals.com and click on the link at the top of the page. Well now, without further delay, and for much more on silver, let's get right to our exclusive interview with author and resource sector industry insider, Peter Kraut.
Greetings once again. I am Mike Meharry, and I'm joined today by Peter Kraut, a fine analyst who, in my opinion, has written one of the best books out there relating to the silver market. Peter, thanks for coming on the show. How are you doing today?
I'm doing well, Mike, and always a pleasure to be here and chatting with you.
Yeah, absolutely. It's an exciting day to chat with you because this morning, as I was working on my podcast, I went and I checked the prices, and I saw silver, at least briefly, was trading above $59 an ounce, which is really pretty amazing. And, you know, we finally got above $50 an ounce in October, and then we had a correction, which I think was kind of expected, but it didn't last long. Are you surprised at how shallow that correction turned out to be and how quickly we've kind of resumed that upward march?
To be perfectly honest, I am a bit surprised. I am and I'm not. Let me explain. First, I mean, you know, I've been around this so long that on the one hand, I thought we would be given that really, really strong advance we saw from, let's say, you know, early to late spring all the way through to October. I did expect that we would see more of a correction. Maybe that will still come to pass. I don't know. However, what I will say is that the part of me that is not surprised is that I believe that now a lot more investors have awoken to the situation, and they have decided that they want in. And so there is a lot of cash sitting on the sidelines, simply waiting for, you know, any of even the smallest dips to just go ahead and buy in these, even if it's in these small increments. And that it's almost as though that will not allow, you know, a more of a meaningful correction to happen. And maybe what we end up getting, which we've had multiple times historically in silver, and even, you know, in the last let's say last few silver bull runs, we get these consolidation phases instead of larger corrections. And so you can have corrections in two ways. You can have them in terms of percentage, and you can have them in terms of time. So you could have a less of a pullback, but a longer sort of sideways move. We don't seem to be getting much of either. Yeah. And that's what is a little bit different this time around. But if anything, we may end up in more of a consolidation phase here. Yeah. So I mean, those are, I guess, some of my thoughts on what's been happening.
Yeah, absolutely. I was surprised too. I kind of thought once we got in that 51, 52 range, it would kind of test back down, but it's really been vibrant. You mentioned the fact that there are a lot of folks that are kind of waking up and starting to pay attention. Do you think that the fact that gold is, trading between 4,100 and 4,200, that's very expensive, maybe is having some people go, maybe we'll look over here at silver? You think maybe that dynamic is at work as well?
Absolutely. And I've been saying that for the longest time. I even talk about that in the book, and how, once people start to, gold is king. That will always, I think, be the case. And so people will see that, follow that first. And I guess a lot of people have started to hear and realize that gold is over $4,000. Not that long ago, it was under $2,000. And so it's more than doubled in a matter of a couple of years. And people are realizing that it's really holding up. There are a lot of big fundamental drivers for gold to stay at where it is and climb higher. And they're saying, geez, it's funny. Someone actually who's not in this business at all recently said to me, I was just shocked by this. He said to me, he goes, I don't feel like I own enough gold. This is not someone who follows this space at all, I can tell you. And that really, really surprised me. And when I heard that, I thought, okay, this is probably quite representative of certainly not everybody, but a significant portion of the population that has perhaps some accumulated investments, liquid investments, and realizes that they need to have not just inflation hedges, but things that have some really strong potential upside. And when they see gold over $4,000, they're starting to look at alternatives. And I think that is part of what's driving silver right now.
Yeah, I agree completely. I've had some of those anecdotal experiences as well. Folks that are friends that aren't really engaged in they're not reading the financial news every single day, and they've come to me and said, "Hey, Mike, I know you do gold and silver. Can you tell me a little bit about it? How do I get in? Should I have some?" And there's definitely a growing awareness. I mean, you can't ignore it. For years, the mainstream has kind of ignored precious metals, and it's hard to ignore the fact that they're the best performing assets out there. And you talk about silver, it's doubled this year almost.
Yeah.
It's pretty amazing.
It's phenomenal. In fact, a little I think interesting point to raise here is that I think it's Morgan Stanley that a little while ago said that their new sort of standard portfolio allocation, rather than being 60-40, is 60-20-20, and that 20 goes from, I believe it's the bond portion goes from 40 to 20, and the other 20 goes to gold. Yeah. So, I mean, if someone like that is willing to, stick their neck out like that and say, this is how your portfolio needs to be set up for the long term going forward, that is huge from a mainstream investment bank like that. So I think, hearing these kinds of things from these kinds of players is starting to trickle down to more mainstream investors, and they're hearing it, they're getting it, and they're acting accordingly.
Yeah, absolutely. And since he made that statement, I've seen that pop up in other articles and other mainstream interviews, other banks. So that's starting to percolate out there. And when you think about the fact that, you're talking about a 20% allocation to precious metals, even if you distribute that between gold and silver and maybe miners, most people aren't anywhere near that allocation. I think that if somebody has 2% of their portfolio in gold, they're probably at the higher end of that curve. So,
Mike, I have some interesting data on that. In fact, it's Oxford Economics, which I think about 2 years ago, they put out some research on silver. And what they did was they looked at the prior couple of decades or so, and they looked at allocation to silver, just silver. And the average, they split it out to sort of low, medium, and high risk portfolio. But let's just pick medium risk. So they said to have the optimal allocation to silver. In other words, so where you get the biggest benefit by being exposed to silver with not only return, but also by lowering your portfolio volatility, was 6%. Well, the average allocation was 0.2%.
Wow.
And it was indirect exposure to silver. So you'd need to, the average portfolio would need to 30x its allocation to silver just to get the optimal allocation. And this was, they were making forecasts going out 10 years. They looked at the past and then they said, okay, based on what we expect, how gold has performed, in the previous, say, couple of decades, and what they were forecasting going forward, they said you need to have a 6% allocation in your portfolio to silver to have that optimal, a medium risk portfolio to have that optimal allocation. So imagine if we even move slightly towards that. I mean, I don't think we're going anywhere close to it, frankly, but even if we move slightly towards that, just to have 2%, you'd have to 10x people's exposure. That's just, off the charts. The implications are huge. And I was actually at so McGill University, I'm an alumnus. I was, they started, to their credit, some young students started the McGill Mining Club. Just a little while back. So I was asked with actually, a guy who's quite, who's starting to get quite the reputation in this sector. His name is Michael Gentile. And so he's an investor in the junior miner space. So he was there as well, a couple of others, and they asked me to come and speak about silver. And the first chart I put up was not even about silver. It was about commodities. And it was the Goldman Sachs commodities index to the S&P ratio. So what it is you're dividing that index by the S&P. And this goes back, this chart was like 50 years or something. And other than in, say, 2000 or so, when it was a secular bottom, we are arguably at the next lowest level we have been in the last 50 years. So despite what commodity, and they've actually done well over the last couple of years, I will say in gold and silver in particular, we are still at nearly the very bottom. And so I was telling these students, I said, if you grasp this chart, this is the most important chart I can put in front of you right now. If you can grasp what this means and where we are, where we stand and the potential, I said, you just have the most exciting opportunity ahead of you. You don't even have to spend a ton of time, getting involved in researching stocks or whatever. Just make sure your portfolio has a reasonable allocation to commodities, even say whatever, 20% or something. And over the next decade, you are going to do extremely well. And it could make up for a lot, if you want to continue to maintain a regular exposure to stocks and to bonds, and those, let's say, my opinion, will not perform all that well. This could go a long way to making up for underperformance in the rest of your portfolio. So, that's just some of the stuff that I think is out there. People need to realize the opportunity in commodities as a whole is just off the charts.
Yeah, absolutely. Because it's clear that we are rotating into an inflationary period. Despite all of the rhetoric you get from the powers that be, that inflation's tamed now. It's not. We're back to the money creation. So that bodes well for commodities because you're going to have more dollars, chasing Absolutely. these finite real hard assets. And
exactly. I mean, in my recent presentations, I put together a chart which shows the average inflation pre-COVID and now the average inflation since we've, it's gotten more tame, frankly, since sort of mid 2022, when it peaked at 9% in the U.S. So pre-COVID, we averaged about 1.5%. Since it's kind of dialed back, we've averaged, which is, I'm going to say, early 2023 or so, we've since averaged 3%. So it's double what it was pre-COVID. The Fed's target is still officially 2%, and they're cutting rates.
Yeah.
And I think that's what silver and gold are sniffing out, have been sniffing out all spring and summer, knew this was coming, and said, all right, that means clearly central banks have caved. They know there's no way they're getting inflation under control. They will sacrifice inflation. They will sacrifice the currency. They'd rather simply try to support, jobs and the economy, and that's what they've chosen to do. And if they're cutting rates when inflation is 50% higher than their target, then all bets are off. It's a game of chicken. Yep. They've caved, and so it's go time, and that's what I think what we're seeing.
Yeah, I think 3% is the new 2%, to be honest. I don't know that they'll ever say that, but I think they're okay with 3%.
Exactly. Frankly, Mike, I think we're going to start to see over a little bit of a longer time period. I think we're going to start to see 4% as the new 2%. And, things like bargaining power by labor, things like the end of globalization, the ongoing energy transition, and now massive renewed defense spending globally. I think all of these things are going to support higher structural inflation, and it is in many ways a repeat. History rhymes, doesn't necessarily repeat, but so it's a big rhyme, I guess, on the 1970s, and I think that's probably our best analog.
Yeah, absolutely. I was talking to another analyst a couple of weeks ago, and he made that very same point, that there's a lot of analogies that you can draw between the 70s and where we are today. So,
Mike, if I may, one of the most important, perhaps, points that we can compare, but without an analogy, is, and this I do clearly talk about in the book, the big difference, and I'm sure it's globally, not everywhere, but in at least the developed world, it's probably quite comparable. In the U.S., the debt to GDP in the 70s was 35%. Today, it's 125%. So if anybody thinks we're going to get a Volcker who's going to step in and hike rates to 18, 20%, you can completely forget about that. That is simply not happening. That, if you want to destroy an economy within 6 months, that's what you need to do today. I don't think, frankly, probably lead to a revolution. That's not going to happen. It's just simply not going to happen. And so if anybody thinks, or if anybody is wondering about the odds of seeing low and or lower rates, that's the best sort of support I can give to that kind of expectation.
Yeah, absolutely. On my podcast today, I title it "Math Wins," and I talked about some of these things that because there's so much political spin. We're gonna give rebate checks for all this tariff revenue. Well, do the math; it doesn't work.
Exactly.
I want to talk a little bit about the kind of the nuts and bolts of the silver market. We had this silver squeeze in October, where we saw a significant shortage of metal in London. A lot of that was kind of driven by demand in India. In fact, here at Money Metals, we sent several pallets of 1,000-ounce silver bars to India, believe it or not.
Oh, wow. No kidding.
So that shows how much displacement there was in the physical market. So
amazing.
We moved a bunch of metal from New York to London, apparently, and it kind of eased the squeeze. And so, now everybody's like, oh, everything's okay now. And yet we're still seeing silver climb. And I saw an article the other day that said, well, now we're starting to see some metal shortages in Shanghai. Is there something more fundamental going on here than we just don't have the right amount of metal in the right place?
Yes, I absolutely believe that. And I was going to bring up that very same point. I'm actually looking at a chart right now that shows silver stockpiles in China dating back to 2015. So it's a more than 10-year chart. And we are at, I'm going to say, 9-year lows. They've just been falling and falling and falling. And they peaked in, I'm going to say, mid 2020 or so. And yes, a bunch of silver, from my understanding, was shipped to London to help at least temporarily meet the demands and the shortage there. But that's just it's a shell game. All you're doing is moving around a little bit of silver. There still isn't enough of it, and so. I mean, I might have mentioned this to you before in a previous interview, but about a year ago, a large silver miner told me they sell half of their production to China and the other half to the West. And at the time, and I would assume it's the same, if not worse today, the Chinese were saying to them, "We will pay you $2 over spot for every ounce, and we will pay you 2 weeks in advance of delivery."
Wow.
And that was how badly they needed their silver. I can't imagine that has changed. I can only imagine it's probably gotten worse. So yes, I think there is a big, the market is extremely tight, and you may have seen or heard there was some talk over the last few days. I'm not sure if this has been confirmed or not, but I believe it's JP Morgan moved their trading desk from New York to Singapore over the Thanksgiving weekend. So as far as I know, no press releases. So, a disclaimer here. I'm not saying this is a fact, but I'm hearing this a lot in social media, and I don't know that it's being denied. So if that's the case, to me, that says too that it's the physical markets, which Shanghai is, are starting to become the go-to markets to track the silver price, as opposed to the futures markets. That's becoming a lot more important today, and that's a sign of a very let's just say a more perfected price discovery.
Yeah. I like the image of a shell game, because if folks that have played, there's always one shell where there's nothing underneath, right?
Exactly.
Or two. So what does that tell you? It's not that the metal's in the wrong place. It's not that it's under the wrong shell. It's just there's just not enough metal to go around.
That's right.
That's a pretty fundamental thing. So that kind of leads to the next question. We've seen silver double in price, but silver mining ETFs have really only performed. I don't think they've performed as well as the physical market has. When will there be a substantial leverage in mining stocks compared to physical, in your view? And what's it going to take to produce more metal, or can they even produce more metal?
So the first part of your question, I would answer by saying it's probably not going to take all that long. I think that as we see, there's a bit of a trickle-down effect we have seen, and even that has been muted for a few reasons. So what I'm talking about is, let's say, the larger producers of both gold and silver. I saw a fantastic chart by a friend and colleague in the space by the name Tavi Costa. If anybody wants to follow great charting, follow Tavi Costa on X or LinkedIn. He does a fantastic job. He's with Crescat. And he had a chart that showed how, although the prices of the large producers, gold and silver miners, had risen pretty dramatically over the past year, they've actually gotten cheaper, because the gold price had moved up so much. The gold price had moved up faster than their share prices. So their price earnings went down. Their price earnings ratios went down. They got cheaper as their share prices went up. And so we've started to see some moves in gold, but especially, frankly, in past year or so in silver, where there were 3 big acquisitions that took place. There've been a couple more since, and I just think that this happens over time. We've seen these big names move. Plenty of the juniors have moved as well, and we're starting to see, I think, rotation by generalist investors from general stocks, which these days seems to be completely dominated by tech, into where there's some real value, and there's clearly some real value, and based on that chart where the value's gotten even deeper. Yeah. Frankly, as the prices have moved higher. And so it takes some time to work its way through, but I think we could easily, over the next couple of years, have some tremendous returns in this sector. I can tell you that, I've got 2 newsletters. One is a subscriber-based one is a free one. And the response over the last, say, 6 months has just been tremendous. A lot of new subscribers. People are just hungry for information, want to know more about this space, which companies, are interesting or better for whichever reasons. And so, yes, I think this will absolutely come and trickle down. Mike, I have to admit, I don't remember, what was the second part of your question?
That was a great answer to the first part. And the second, that wasn't really a very good question, to be fair.
That's okay.
I plugged too many things in one question. But the second question was just thinking about the miners. Can they up production to help kind of fulfill? We've had 5 straight years of a market deficit where we've seen supply falling below demand. So can the miners catch up?
So to me, the quick answer to that is no, they cannot. In fact, even the Silver Institute back in, I believe it was April of this year, forecast that we would continue to have over the next 5 years, not only ongoing annual deficits, but we would set a new record deficit over the next 5 years. So the miners, they cannot keep up. We peaked in terms of mine supply back in 2016 at 900 million ounces. We're down around 830 million ounces, and demand has gone up 20%. So demand up, supply down. I mean, that part of it is economics 101. It's compensated by price, and that clearly has helped explain why the price finally has caught up. I've been saying it for 3 years. It was going to happen. It started to happen in a big way over the past year and a half. Silver prices, as you said, this year alone doubled. And so we're going to see more of this. It takes, 10 to 15 years, let's say even potentially longer than that, from the point of discovery of an economic deposit to the time when, it starts to come out of the ground and actually be produced. And so, of course, what helps, absolutely, is these much higher silver prices, because there are now clearly more deposits that become economic. So that's interesting. That can help supply. It's a question of time getting these things approved, getting them built, and then getting them producing. And as far as, if you look at these, I just mentioned that there were these bigger names that went out and bought out other competitors over the last year or so. Well, that doesn't help supply. All it does is it changes who is, now owns that mine and is supplying it, but it doesn't add a mine to the market. All it does is shift who the new owner is. So supply will remain, mine supply will remain very constrained. I think there was a small bump up there's an expected small bump up in recycling. That makes sense, with higher prices. But as far as people selling hoards of silver, there's arguably several billion ounces of silver owned by individuals that could come back to market. I've been saying for a long time, and frankly, based on this exacerbated supply issue recently, I think it's supporting my view that this metal comes back to market at higher prices, not even at $50, $60. It's going to have to be substantially higher than that.
Yeah, absolutely. I agree with that completely. I'll give you a real quick factoid along those lines. If you take the cumulative market deficit shortfall over the last 5 years, and that's including the projected shortfall for this year, it is basically the same amount as 1 year of mine output.
Exactly.
So, yeah, it's pretty amazing when you think about just how big that shortfall is. I've got about 35 more questions for you, but we've run out of time. So I'm going to be respectful of your time. I know you're busy, but I do, before we go, I definitely want to give you an opportunity to point folks towards your newsletters, tell people about the book and where they can avail themselves of more from Peter Kraut.
Okay, thank you, Mike. So, yes, I publish a subscriber-based newsletter called Silver Stock Investor. You can find more about that at silverstockinvestor.com. And 3 years ago, I published a book called The Great Silver Bull, which is all about the macro setup for precious metals and silver in particular. And then I talk about the history of silver, supply, demand, how to invest, and ultimately, where I believe the market will go. So you can find that on Amazon, and I'm very active on X and on LinkedIn, so you can certainly find me there as well. And happy to interact with your viewers and your listeners.
Yeah, absolutely. And every time I have you on, I brag about this book. It is fantastic, and people might think, "Oh, he's just sucking up to his guest." I like you, but the book is good and it stands on its own. So folks need to check that out. Just, and if you think I'm wrong, then you can come at me. But
thank you, Mike.
Yeah.
Thank you.
I really do appreciate you taking the time and what an amazing time. Well, I'm sure we'll want to get you back on in the near future because there's just so much going on and it's really exciting. I'm holding on to some silver I bought at $12. So I like watching this. It's fun.
Mike, if I can sort of maybe leave your listeners with one final thought.
Yeah.
In terms of the potential for mining stocks, silver mining stocks, the last data I have, which is I think from, let's say, the last month or so, the publicly investable silver mining industry, that includes explorers, producers, royalty companies, everything, is about $50 billion. The publicly investable gold mining industry is $950 billion. So it's about 5% of all of gold public mining companies. So when people decide they want to invest in silver mining, there are so few names for that money to go into. I like to quote Doug Casey here. He says it's like trying to, flow the contents of Hoover Dam through a garden hose. There's only so much capacity. The bandwidth is very small, and that just makes these names explode. So, that just gives people some idea of, the kind of potential there is going forward.
Yeah. So much potential in this market, and it's amazing that we're talking about potential still when we've seen the price gains that we've seen in the last year. It's amazing, and the same thing with gold. I mean, I think gold still has a lot of upside. All of the things that have supported this gold bull market are fully in place, and
exactly
same thing with silver. So, well, again, thank you so much for taking time out of your day. I hope you have a wonderful holiday season, and once we get into the new year, we'll have you back on again, and we'll see what's going on with silver when we get to that point.
Thank you. Thanks so much, Mike.
Some more excellent analysis there from our friend Peter Kraut, a great man to have on right now, given the fireworks on the silver market. And I hope you enjoyed that interview. Well, that will do it for this week. Be sure to check back next Friday for next weekly Market Wrap podcast. Check out the Money Metals Midweek Memo podcast as well. To listen to any of our audio programs, just go to moneymetals.com/podcasts or find them on places like Apple Podcasts, Spotify, and other podcast platforms. And as a big help to us, we would ask that you please like, subscribe, download, and rate our podcasts. Doing so helps us extend the reach of this material. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.